What happens to my infinite banking plan if I cannot make premium payments? That's the question we're diving into today, but before I forget, make sure to hit that subscribe button so you don't miss any other content like this. Without further ado, let's jump into it. So, what does happen if you can't make the premium payment in your infinite banking policy? The answer is, it depends. How far are you along in the policy? If this is the first year and you can't make the premium payment, then I think we've got bigger problems because, well, if you haven't made the premium payment, the policy's not enforced, so just don't make it. Now, if we're in the second, third, fourth, fifth year, there is something to talk about here. Now, it's pivotal that your infinite banking policy was built correctly, especially in a scenario like this, because when your infinite banking policy was built correctly, it should have been maximum overfunded up to the modified endowment contract limit and the minimum death benefit that we can get, so the costs are as low as we can get them. If this is the case, you likely have a large amount of flexibility. In fact, if your policy is older than 4 or 5 years, there's a strong chance that you could just stop making premium payments forever, and the policy wouldn't only survive, but it would be extremely efficient. That's how all of the policies are built for my clients. Here's how we describe it. You've got the base premium of a whole life insurance policy, which is going to represent more the pure whole life or traditional whole life that you'd expect to see. And then you've got the overfunded portion of the whole life insurance policy. So you have the base premium plus the overfunded portion makes up the total premium. If your total premium is $100,000, your base premium is likely sitting somewhere around $20,000. So your base premium is $20K, your maximum premium is $100K, $20K is the base portion of the whole life, $80K is the overfunded paid up additions portion of the whole life insurance policy. That $80,000 in the paid up additions portion or the overfunded portion is optional premium, meaning you don't have to make that payment every year. In fact, you can never make that payment and the insurance company isn't going to be mad. Your policy won't be in trouble. It's the base premium that the insurance carriers are worried about. That's what they're wondering. Where is it coming from? So the $20,000 in this example, the $20,000 is really all you have to come up with. So you've got a ton of flexibility. You can fund anywhere between $20,000 up to $100,000 as the maximum limit of your funding range. So let's say that you get to year 3, you've set the policy up just like this, where $100K is the max and $20K is the base, and you funded $100,000 the first 2 years in a row, but unexpected expenses came up, and let's say you only have the $20,000 for the base. Just plug in the $20,000, go ahead and wait till the next year, and you can go right back to putting in $100,000 a year in year 4. The only way that this is possible is if your policy was built correctly from the forefront. So, in every video that I talk about infinite banking, I always mention this. Make sure your policy is built correctly because the flexibility of your policy is totally dependent upon how it is built. Now, in the same scenario, let's say you put in $100,000 year 1, $100,000 year 2, and in year 3 you don't have anything to put in. That is okay still. And the reason is you have $200,000 that you funded the previous 2 years, which means your cash value is likely sitting somewhere around $170,000 right now. So what will happen is the insurance company will take $20K from the $170,000 cash value. They'll put that $20K towards the base premium for the year 3 funding. The majority of that $20,000 base premium is going to go right back into the cash value to build additional cash value. There's only about $2,000 or $3,000 at that point that would come off as actual cost. And so what would happen is your cash value would go from 170 to 150K. You would fund the 20,000. That would bump the cash value back up to 167, 168,000. And then it would earn the guaranteed interest plus the dividend. And so it would likely be sitting somewhere around 177, 178,000 the next year. So even if you can max fund your policy for at least the first 2 years, this is going to provide a ton of flexibility for you moving forward. If you can't fund it for even 3 or 4 years in a row, that's totally fine if you funded it at the maximum amount during those initial couple of years. It's pivotal that we overfund the policy during those initial couple of years because that provides us with a ton more flexibility that we will enjoy for the life of the policy. I hope you found this video helpful. Make sure to drop any comments or questions in the comment section below. Make sure to hit that subscribe button and like this video, and we'll see you on the next one.